This is our supply chain finance roundtable interview. We have our supply chain finance event coming up at the start of September. And we have a list of questions here for this roundtable. Starting off will be Tony Brown, who's going to discuss macro trends in global trade and supply chain finance. And Tony, the first question for you is, how are shifting geopolitical alliances and trade tensions impacting global supply chain financing strategies?
Yeah, right. Well, I have to say I've been in business about 50 years in international trade, and I don't think I've ever seen a time more tumultuous, more chaotic for people in cross-border trade than right now. So there have been a huge amount of things that happened. There's been obviously a shift away from China. Sourcing has moved to Southeast Asia, Latin America. We've had some nearshoring and friendshoring, and these have required supply chain finance programs to adapt to a more fragmented and diversified supplier base. With that, obviously, and the tariffs, which are chaotic, I mean, they've ranged from 145% for China down to 10% for others and 30% and anywhere in between. And the dust is still not settled as we speak. August 1st is the sort of date where everyone's expecting things to sort of settle, but with this concept of Trump always chickens out and the taco trend, who knows what's going to happen. But one thing's for certain, there is going to be cheating. People are going to ship to different countries. Chinese goods are going to go to Vietnam and appear to be Vietnamese, but they're really Chinese. You're going to have a lot of tariff engineering where people are going to design products so that they fit a certain tariff category. And this is going to cause the need for an immense amount of due diligence in terms of compliance. Because if you're lending against inventory which you think is a certain tariff category, and it turns to be something else, where the goods are impounded by customs on arrival, that ain't good. The other thing is that there's been currency and interest rate volatility. Interest rates are still high. If tariffs are inflationary, which they expect to be, interest rates will remain high. We know that when interest rates are high, that's not good for business. It weakens the economy. There's likely to be more bankruptcies, and that's likely to give rise to possibly stagflation or a credit crunch. But inevitably, the dollar has weakened, which is weird, because normally in times of stress, the dollar increases in value because it's a safe haven. But for various reasons that we don't need to go into now, the United States has lost that safe haven status. It's now being questioned as a safe place to do business. We've had a situation where our sovereign debt has been downgraded a notch. So all of this has to be taken into account. One thing's also the case is that if the dollar drops, that makes imports more expensive. And if tariff rates are high, then that is really likely to be quite inflationary. So with that backdrop, you can see that there is an inevitable impact on how supply chain finance is going to be affected. And there's definitely a lot of reshaping going on. As far as factoring is concerned, supply chain disruptions, inconsistent delivery, fulfillment issues are likely to give rise, in my opinion, to AR volatility. And certainly as banks perhaps pull back from balance sheet lending, I think factoring is likely to be a winner, especially for small and medium-sized companies. And certainly receivables financing to manage cash flow volatility is a well-known and effective tool. As far as asset-based lending is concerned, I think that's going to remain resilient as traditional cash flow lending tightens in the economic scenario that I described earlier. Advance rates and pricing on inventory is likely to be volatile because inventory values are likely to be affected by foreign currency and tariffs. So advance rates may have to be adjusted because formulas that lend against inventory with inventory values being higher are going to be somewhat out of whack, in my opinion. A very likely winner in this scenario is reverse factoring, or supply chain finance, as it's often called, because people are going to be looking to augment their cash conversion cycle. Buyers are going to want to be given longer terms from their suppliers, but suppliers, particularly in developing countries where access to capital and the cost of capital is more restricted and higher, respectively, they're going to want to get paid early. And so reverse factoring is definitely a technique for them. The other thing is that with the US dollar dropping in value, the foreign supplier wants to avoid the foreign exchange loss from waiting in a dollar dropping environment to get paid earlier as a foreign exchange mitigant. As far as inventory is concerned, I think third-party inventory ownership financing, also called inventory monetization, is on the increase. We've seen some companies offer $4 billion facilities to companies that are selling to very large corporates but need to stockpile inventory for them because large corporates don't want that inventory on their balance sheet. And so the smaller suppliers of technology, for example, they can't hold the inventory either. So there's been an increase in the number of sources of third-party inventory ownership, and I think that's likely to continue. PO finance, of course, is a variant of that, and certainly foreign suppliers are going to want to get financing as early as possible, whether through a letter of credit or a purchase order finance payment, a guarantee or disbursement, so that they can put those goods, that money, to work to make more goods. So all in all, I think we've got a situation where the climate is volatile. Strategies for supply chain finance are going to have to be adaptive, risk-aware, and there's going to be need for supplier support, cash flow optimization, and compliance issues. So a complex situation. Have fun. I think you're on mute, Eileen.
All right. Thank you, Tony. That was great. And you mentioned about factoring coming out of this as a winner. And we have a question for Alan. Is factoring undergoing a reinvention in the digital era, or is it being cannibalized by fintech alternatives and supply chain finance platforms?
Well, it is definitely being reinvented, but cannibalization, especially by the fintech world, the MCA world, is happening more and more. And what's happened is the MCAs are so available with funds to our clients or prospective clients, and they close so fast. Factoring can close deals, at least Prestige Capital will, in 5 to 7 business days compared to a bank or an asset-based lender that can take 30, 60 days or longer. But MCAs will close in 24 to 48 hours. So when a client needs funds, that's their first and easiest method, even if the expense is much greater than any other traditional method, factoring, asset-based, or banking. So we've had to reinvent ourselves by becoming more reactive, funding even more quickly than we did, changing our pricing model, even though we are less expensive than MCAs by far. We still, because of competition, have had to reduce our pricing and change our pricing model. So for example, where we never charged, in our case, minimums, we didn't charge usually closing or facility fees, but our pricing on the factoring side might have been a little higher. We've changed that model again, so we're able to compete not just with the MCA world on getting closed more quickly, but be able to price it so that our competitors in the factoring world were able to be able to be competitive with them. The fintech world is just out there on every deal we see. And what's also happened is that as we look at prospective clients, where we thought the AR, if it was 2 million and there was usually either a small bank loan or an SBA loan or other small funds that we were able to augment or supplement the client's cash flow, now they have 4 MCAs out there, and sometimes the total exposure is greater than the availability that we have to do a deal. So we are having problems certainly with the MCA or fintech world, and the supply chain or reverse financing is also causing us problems, because what happens there is a prospective client might be dealing with one of the large retailers that is offering a program that is very quick, reasonable, and in many cases cheaper than the factoring money. So they take that program and it reduces the availability of funds under our formula of what we can advance. And either it means we now have a smaller deal with that client, or sometimes we just don't even get the client at all because the amount available after this reverse factoring or supply chain just doesn't give us any available funds. When you look at what you're saying on the second part of this, the tariff portion, the tariff war has hurt factoring, not so much in the recourse versus non-recourse. What it's done is it paused some of the clients' deals. We have a client that had a $1.5 million order with a large retailer. They were bringing in or importing the funds from China, the goods from China. And what happened with that deal was when the tariffs went up so high, the deal became no longer profitable. So they paused the entire $1.5 million order. Even though they went back to the retailer, they were able to get some concessions on pricing, but not enough to make the deal profitable. So the whole deal went on hold. So we've had existing clients that have paused orders. We've lost potential prospects that are no longer going to be needing factoring, maybe for the potential future, because the tariffs hit them so hard. It didn't cause much of a shift in the recourse, non-recourse. That happened 4 and 5 years ago when COVID hit. When pre-COVID, most of our factoring deals were non-recourse, almost all of them. When COVID hit, the companies that you thought were creditworthy, not just retailers, but many companies, were no longer creditworthy because there were so many problems hitting in the COVID world, and the payment cycle changed. Many companies that used to pay in 30 to 60 days were now saying they had to pay in 90 to 120 days. So a lot of things shifted during COVID, and we had to go back to all of our existing clients and any new ones and say, any deal that we had that was a non-recourse deal, we had to immediately change to recourse, because we told them otherwise we make a decision on the creditworthiness of your customers in 24 hours. We would now need 30 days potentially, or we couldn't credit protect them at all. So we just went out to all our clients and said, in order for us to continue factoring, we needed to change that deal from a non-recourse to a recourse in full. And almost all of our new deals now are on full recourse to the client. That was a shift, not because of anything in the tariffs, but because of COVID. The whole world really changed during that time period. As far as the large retailers, again, that is hurting us badly with all their bank programs or self-funded programs, that it's taking away a lot of potential funding that we used to do. We're still getting a good number of new deals. We're still funding a lot of existing clients, but the amount of funds that we could advance has shrunk because of that particular reverse factoring done by large retailers.
Thank you,
Tony?
Alan.
Yeah, Tony
Yeah.
has a question.
Yeah, Tony, did you have anything to add?
Yeah, I was just going to add on the digital side. I think there is a very beneficial effect of digitalization on factoring. I think you've seen the uptake of AI. I know that at the IFA conference recently, there were several vendors, AI vendors, looking to assist in improving the process of verification, for example, using like natural speech to interface with an accounts payable department at a customer. I think that's a very great benefit because we know how intensive the process is, labor intensive, and therefore expensive. The other thing I think on the digital front is that you're finding a lot of platforms, particularly like procurement platforms, now embedding a factoring option. So when procurement issues a purchase order and a seller invoices, there is immediately within the platform itself an opportunity for the supplier to obtain a payment. So I think that's likely to have an impact on factoring volumes.
Yeah, agreed, Tony. But the AI portion is an interesting one because it's going to benefit us, but it also can be a hindrance because the verification side can certainly be expedited by AI, but at the same time, we are still very old-fashioned where we like the personal touch and relationship that is involved with somebody in a payables, in a warehouse, whatever it might be. And we feel that's very important in our industry. So AI is both expediting, but can be a hindrance in some ways. And the other side of the coin is everything that we do, unfortunately, fraudsters do as well. And they use AI, and it's sometimes hard to differentiate a fraudster using AI from the real potential debtor that we're trying to reach, and even sometimes the client, because they're usually, in the fraudster's case, one step ahead of almost everything that we do. And unfortunately, it includes something like AI. The part about the using the digital and the technology, you're right on the purchase order side, where many times the information becomes more readily available to us. But again, maybe we're just old-fashioned, and as my business partner and I say sometimes, maybe even dinosaurs. But everything to us is also relationship driven. So even when we reach out to the purchasing side to confirm a large purchase order, many times we're still doing that phone call and the hand-holding touch of communicating instead of just using the digital and AI side of that. So you're right, it can help, but we're still a little old-fashioned in how we do it.
Bob, you had something to add?
Yes, I do. Look, channel and dynamic financing is starting to eat away at the pie of factoring, but there is an element to keep in mind. It usually takes at least 10 to 14 days to those invoices to be processed and posted on these platforms that get paid. So a lot of times a factor can say, I want the assignment, I'll lend you money day one, and day 15 or 20, I'll get paid on it. So you still have the opportunity to structure a deal where you can finance those companies that are typically investment grade and make your commission and make some interest dollars. The other side, and more importantly, if you're financing inventory, you have a big say as to how you structure the deal. If you're just financing AR alone, you have less levers to pull, but certainly you want the proceeds of your collateral. And typically, depending on the strength of the borrower, you can structure it that they can't use channel finance if that's your prerogative to get the risk reward you want for doing that deal. I think the other side to keep in mind, because AI is a wonderful tool, but it's only one tool in the toolbox. To Alan's point, relationships are key, and you tend to find that when you have an ongoing relationship with a customer, in terms of verification, sometimes you get a lot more information than AI will give you. I think the bigger issue, what I see in the marketplace, is going more towards notification factoring as opposed to non-notification. You want people to know that you bought this receivable, that you can call up and say, I have the right to the proceeds, you need to tell me, especially with the higher probability of offsets, counterclaims arising from the current tariff situation disruption, as Tony pointed out. So I do think it's changing, but I tend to look at the changes as opportunities for us to thrive and make some additional money. Factoring and asset-based lending are two of the most flexible financing tools that you have. And I think across the board, we have to start thinking ourselves as business model lenders and not collateral lenders. Collateral is important, but understanding a business model is probably more important than anything else, especially in today's world.
Okay. Thanks, Bob. Shifting gears over here for a question for Megan. Has there been an increase in risk to inventory finance during the tariff war? And if so, what are those risks and how has inventory finance addressed those risks?
So short answer, yes, absolutely. And for many of the same reasons that Tony, Alan, and Bob have addressed so far. High level, with the increased tariffs, this leads to overall higher cost of goods sold, which ties more capital and inventory costs. When you combine that with supply chain issues such as longer lead times, longer transit times, potential customs holds, and there you have an increased risk. The tariff war has overall just created uneasiness with both suppliers and buyers. This uncertainty, as Tony alluded to, a lot of buyers shifting their supplier base, which means price volatility, price discovery between the suppliers and the buyers. Buyers are trying to find the best rates, and suppliers are as well. When buyers are opting to shift factories from one country to another to avoid the higher tariffs, this creates significant challenges. Is the factory capable of producing the product I need? Can I produce it in the time frame I need? Will the quality be the same? What are the payment terms now? This factory doesn't know me as a buyer. I no longer have my open credit, my open terms. They want some sort of guarantee. They want a letter of credit. At these times, this is when companies are reaching out to inventory lenders, such as purchase order finance lenders or in transit asset-based lenders. And this is a great time to do that because of the challenges. And those different options, in terms of inventory financing abroad, is letters of credit, is cash against documents, it's collision payments, and purchase order finance lenders and asset-based lenders have the ability to provide these types of programs. As a lender, it's always prudent to be cautious when making payments to overseas vendors. We're seeing a lot of fraud, identity theft. We really have to, as lenders, vet these new factories, not only for quality, but also just for the same reasons that I mentioned above. Can they produce? Can they ship timely? And it's very important to make sure that the quality control and testings are all being performed. Another risk that companies are not necessarily realizing is factories shifting terms on them. They might have originally been shipping on FOB terms where the buyer is the importer of record, and the factory is now shifting to a DDP model. And they're saying, oh, we'll be the importer of record, we'll clear customs, but yet at the same time, they're asking for prepayments or deposits. And if buyers or importers are putting up those deposits and prepayments and the goods get here stateside and the supplier did not clear customs, that's just an additional cost that's going to stack up in terms of the overall shipment cost. And as Alan alluded to, profit margins are just getting shrunk and shrunk and shrunk, which ultimately impacts the overall inventory value. So that's definitely something to be aware of. You really need to understand, as a lender and a buyer, the shipment terms from the factory, whether FOB, LDP, or DDP, and that's definitely something we're monitoring very closely. Lastly, but certainly not least, is customer conditions are a huge risk for inventory lenders, especially purchase finance lenders. The whole transaction for a finance lender is based on the customer and the customer, the strength of that customer order. A few years ago, we would not have seen cancellations from Costco's and Walmart's and Target's and other big box retailers, and that's not uncommon anymore. And it might not be a cancellation, but it might be a deferral, which just then extends the transaction timeline. And the other thing I would say about that is customers also switching terms. Walmart might have said, oh, we'll pick this shipment up FOB Asia, where they'll be responsible for the importing and clearing customs and the freight. And then at the last, during this tariff war, they're saying, no, actually, you have to be responsible. You have to make this more of a domestic import. So it's just constantly shifting. And, as lenders, we have to just stay vigilant, constantly monitor cash flows, in transit shipments, inventory levels, and customer orders.
Mhm. Right. Brian, you had your hand up earlier. Did you have something?
Well, yeah, and I think it dovetails to the next question with regards to the benefit of utilizing additional partners in the supply chain, and then from a supply chain finance perspective, there are quite a few added risks associated with supply chain finance right now. And Tony brought on obviously a great point. With all this uncertainty and all this risk comes the need for our industry to really step up, and there's a great opportunity for the non-bank, non-traditional lending solutions to be able to provide quite a benefit and value to the borrowers at a risk mitigated perspective. Megan hit on a lot of different really good key ingredients, and it requires lenders to really get into the weeds a lot more, to understand, as Bob kind of indicated, the business model, the relationships between buyer and seller, our clients and their suppliers, our clients and who their customers are, and understanding the dynamics associated with what all this uncertainty is bringing about. You're trying to mitigate risks, but I promise you, everybody else in the supply chain is trying to do the same thing. The old adage of, for every action, there's an equal and opposite reaction most of the time. And I will promise you that a lot of folks on the other side of the ocean is, they're trying to mitigate their risks. They're trying to understand how they're going to make sure they're going to get paid and maximize their profits. And so all this uncertainty brings about the need for a lot more understanding, a lot more transparency, and a lot more structure in many instances. And you got to get in the weeds if you're a lender and understand that, hey, is our borrower able to effectively source goods? Are they able to make sure that they're not getting in a situation where they're paying for old bills and they're not getting product and their cash flow starting to really, really wane? Are they sitting on a lot of inventory that they brought in ahead of time to mitigate this risk of tariffs, but all of a sudden now their demand has shrunken? We're seeing a lot of that right now, where a lot of the orders that are being issued by end customers were actually verifiable and firm orders. But now, as we've gotten down into, we've gotten 2 or 3 months down the road, they're looking at saying, well, you know what, our inventory levels are normalized, we don't need any more, and guess what, we're going to push back these deliveries. So now are you sitting on a lot higher priced inventory at lower valuations? Are you able to manage the process of sourcing product with new suppliers who are requiring different payment terms, as opposed to added old terms that were, hey, you get 30 or 60 days to pay us as an overseas supplier. Now no longer are you doing that as an importer. You're having to prepay for product. You're having to actually pay old bills because the concern for the overseas suppliers getting paid is starting to increase. So there's a lot of need for this benefit of utilizing added availability that folks like purchase order financing or reverse factoring can provide in the supply chain to keep a customer happy. But yet, as the lender network, all the stakeholders involved get to benefit from all this added risk mitigation by what all these different products add to the mix, but yet keeping the customer happy, keeping the customer healthy by having availability and making sure that all the borrowers are being able to make sure they're managing their business right. So all this added expertise in this time of uncertainty is really a benefit, and that's the reason that added financial partners in supply chain do provide quite a value to not only the borrowers but also to themselves and all the other lenders involved.
Thanks, Brian. Tony, I think you had your hand up first.
Yeah, I wanted to just add something to what Megan was saying about this trend to, well, tendency to want to buy delivered, duty paid, and pass the whole responsibility to the foreign supplier to bring the goods in, make the goods, ship the goods, customs clear the goods, pay the duty, and deliver the goods as if they were a domestic vendor. That all sounds absolutely hunky-dory, except it's fraught with risk. First of all, the supplier may not be so honest, may I say, in terms of compliance with all of the tariff and product classification requirements. Yes, they are the importer of record, so they do have to comply with the MOD Act and keeping all of that information. And if there's been an issue, they are responsible. But I think to that end, the Trump administration is looking to stop foreign suppliers being the importer of record. That's something he's raised recently, and that could really put a wrench in the works for that idea. The other complication about buying on a DDP basis is that whereas we said earlier that a lot of suppliers in developing countries have greater challenge of access to capital and cost of capital, if you're really saying to them, I'd like you to use your non-existent available lines of credit to not only make the goods, ship the goods, hold the goods, bring them here, pay the duty, they may well be able to do that, but at what cost? There's no such thing as a free lunch, and those costs are going to be added to the price. So whereas you're avoiding perhaps the tariff exposure, you're not necessarily gaining on the other side of the picture in terms of minimizing costs. The other point I was going to make very quickly is that I think that this scenario, these circumstances, are ideal to bring together those who were previously in silos, the finance function, the procurement function, and the IT. Hopefully, at last, we get them to think as one corporate entity with the various silos, looking at what's best for capital conservation, working capital optimization, and liquidity.
Alan, I think you're
Yeah.
up next.
As Bob and Brian have just said before, all this problems that have occurred between tariffs and delays of orders and adding additional costs, it's allowing those non-banking sources, purchase order finance, inventory, factoring, and even maybe to a lesser degree, asset-based lending. We have all had to become more flexible, creative in what we do, but it does create a lot of opportunities for all of us because, again, the costs are still required. And if an order has been delayed and the retailer unfortunately delays the process even longer, it is adding costs, but it does create opportunities. Every problem that occurs creates something that we have to come up with a solution for. And if the only solution is for the client to go to an MCA for fast cash, that would create much more problems down the road. So we have to step up and be more creative in what we do to help the solution.
Brian?
Yeah, and one of the other risks that I forgot to mention, and Megan, you alluded to it, was just the time aspect of this uncertainty that we're experiencing directly related to the fluctuations in tariffs. For instance, if you're on the procurement side and you've got 60 to 90 to 120 days lead time to get the goods produced and delivered, do you truly know what your cost of goods are? You really don't. And you can be losing money by the time goods actually clear U.S. customs. And now you're bringing goods in where you're essentially upside down. So from a standpoint of the company, you don't know what your true costs are. From a financing standpoint, you don't know what your borrower's true costs are, nor do you know where your collateral is. And so when you've got extended exposure to overseas suppliers in countries where we've got this uncertainty with what tariffs are going to truly be, short of depending on how you're buying from those overseas suppliers and how you want to handle the risks of being the importer of record, controlling your goods, or having the overseas supplier handle that and taking on the added risk that Tony and Megan discussed, you really truly don't know what the costs are going to be. And so you can take that added risk. And so the hard part is managing the procurement by understanding what the true value and what the true costs are going to be at the time the goods arrive. And so that's a big challenge that we're facing right now. Until we get that certainty and know what the rules of the game are, we just truly won't know.
Okay, I see two hands up. Tony, were you first, and then Megan?
Yeah, I want to just follow up on what Bryan was saying, because I do think that the credit environment is going to suffer. I think credit worthiness is going to suffer. I believe that there's going to be more stress in company financials. And I defer to Bob, who I think is probably sort of the credit guru amongst us, as to what is likely to happen in terms of bankruptcies and pullback from available lending limits and advance rates. To me, it seems that this environment is pretty toxic in that regard.
Megan?
Yeah, I just wanted to add to, Bryan kind of hit on it. I just want to add to that. When PO finance lenders specifically are asked to open up a letter of credit, say, 60, 90 days before a product ships, and you're reliant on that order down the road, that 90 days to 120 days. And I think it just increases the risks for inventory lenders, with these extended timelines, just because it kind of comes back to the customer. How strong is that customer order? And by the time these goods are ready to ship, is that customer order still even a valid order? That's a really good point that he brought up, because it all kind of ducktails into one another in terms of longer lead times and cancellations or deferrals from customers as well.
Okay, shifting gears to Bob now. Question about risk management and credit analytics. With global supply chain disruptions becoming the norm, how should lenders and insurers reassess supplier default and geopolitical risk? What are the implications for assessing counterparty risk?
Well, we can talk for a couple hours on the topic, so we'll try to keep it concise. I think we touched on a lot of the topics here already, but it starts with re-underwriting the deal. Clean sheet of paper, everything you thought about the credit or past trends, throw them out the window. And it starts with the business model. How important are you to your customer? If you're selling paintbrushes and they're just a generic paintbrush, the Home Depot, and you tell them you're going to increase prices by 20%, trust me, they're looking to replace you. So you have to, if you're selling a unique item that's patented, they can only buy from you, then you have pricing power, right? So it's important to understand how valuable you are to the customer. And keep in mind, I think Megan pointed it out as well, everybody is doing price discovery. Everybody. Your supplier in China, he's going and bidding up his suppliers. You're beating him up. You're going to negotiate with your customers. You're looking to cut overhead in your company so you have margin, more room to absorb it on the expense side. And what's also troubling, you hear in the news all the time, oh, it's affecting small businesses. No, it really impacts any company with low gross margins. Don't get me wrong, it can impact companies with high gross margins, but you have more to work with. So you can have $1 billion company doing 20% gross margins, that's going to be a problem. Okay, as opposed to you're importing fragrances with a 60% gross margin, you've got a lot more leeway to work with. So it really goes back to starting with a clean sheet of paper and saying, okay, what's your business model? How important are you? What's your gross margin? The other thing that a lot of people don't do, when you ask a borrower, what's your gross margin? They'll say, that's 30%. Well, that's wonderful. You have a lot of items that are 50%. You got a lot of items that are 6%. So when you're underwriting the deal, having the conversation with a borrower and saying, let's look at your product mix. Obviously, if can you get rid of those 6% items without jeopardizing your 40% gross margin items. So it's really taking a deep dive, and you hope that management has already done this analysis, but a lot of times people get lazy. They look at their financials, they got a 40% gross margin. No, there may be room to jettison a couple of products and really concentrate on where you can make money. I think Megan and a few other guys also mentioned, Bryan, the open credit issue. China, over the course of the years, has become a credit grantor, open credit. They did that with Sinosure government subsidies. When I first started my career in finance, you always had to give them a transferable LC so they can finance the production. Now they're giving you open credit. And open credit is the driver of any economy. Too much of it creates inflation, but obviously it helps stimulate credit and business and economic growth. So I think when you're looking at the business model, a lot of people don't understand, hey, open credit now is an issue. And most of these companies that we deal with have gotten used to getting open credit from China. That's changing. And I think, Bryan, you mentioned, or Megan, I forgot who, but people are now looking to get paid as well. So they're not going to be so trusting to say, I'm going to let this shipment go when you already passed through with them 30 days. So I think that is a problem. And it also represents an opportunity for supply chain finance to solve that problem. If someone is credit worthy, you may want to decide, you know what, I can help you solve that problem outside your bank borrowing base. I think that's a really good opportunity for, let's say, the non-investment grade companies that are good credits. Just because they're not rated doesn't mean that they couldn't be investment grade or they won't pay you. So I think that aspect presents an opportunity for us really to get more business going. The other big thing that you really have to analyze is management. How talented is management? The entrepreneurs that are successful are really resilient and very talented and know how to solve problems. I always am mystified when you talk to a borrower, when's the last time you were in China? Oh, 2 years ago. That's not the guy you really want to be lending money to. The guys who are successful, they're going there 3 times a year. They're visiting their suppliers. They have relationships. Those relationships, I think, Alan, you pointed out early on, relationships are key in this business. If you have a relationship with your suppliers, you can work with them. And the trend you're going to start seeing, in my opinion, is a more vertical integration from the supplier to the importer. Whether that means I'm moving the factory to China, but to Vietnam, but I need you to commit that you'll take the production there so I can justify the move. We're going to see more of that to solve this problem. So I think that's also an important aspect of it. Obviously, at the end of the day, we're collateral lenders. I always like to say, I always put business model management. Collateral's got to be your default option if you make a mistake or the markets are too volatile to anyone to manage. And that's the hardest part because the ground rules aren't set. It's like walking in quicksand. Today, this is that. We don't know if the administration may come along and say, well, you know what, you moved the factory to Vietnam, but it's still owned by Chinese. Tariffs apply anyhow on the Chinese rates. So you have all these dynamics, and I think longer term, you're going to be seeing people to nearshore to eliminate as much risk as they can. And I think the buzzword right now, if you're in this situation where you don't know what's going to happen, is to start diversifying your import base. And people have done that during the first Trump administration, actually found out that they can import goods cheaper than buying them from China. It's amazing how that happened. I also think when you're looking at business models, if you're a smaller company or don't have the clout, you may not get a factory that's interested and the quality may not be what you want. The Gap can walk into a factory in India and say, I'm going to give you 20,000 units per week. Oh, I can only give you 2,000. Guess what's going to happen? You're going to be last online in production. Factories like Long Runs, the credit-worthy companies, better than I'm Bob Grbic and I have a $20 million company and I want 2,000 pieces per week. It's going to be hard for those smaller companies to resource. and you're going to find them going to more parts of the world that may not have the best production, may not get clearance by the buyer. Keep in mind that's a big factor that typically the public large buying companies want to have the production factories approved that they're not using child labor and other violations, environmental, wherever they could be. So I think that's another issue that you have to consider. So it's a very volatile situation, and you really almost want to have a dynamic projection model to say, what if we do this? What if we do that? And you got to be nimble. You got to start thinking about what are my options. Diversification is good, but it starts with understanding how important is your business model to that customer. I mean, I would not feel comfortable just importing paintbrushes that have that basically commodity, as opposed to importing say an air fryer that has a branded name that people want. So it goes that first segment. And typically, for PO funders and people that get involved in that financing, that supply chain, we always look for the guys with the higher gross margins that can absorb the bumps we don't anticipate today. So there's a lot of moving parts, but it starts with being inquisitive. Forget about what the files say when you book the deal. Start with what are your options? What are your plans? And if management can't give you rational answers, I'm not worried about it. We'll see how it lays out. It's a problem. Now, one tidbit that keep in mind, sometimes in this volatile world, strange things happen. Like pre-Liberation Day inventory may be worth more in the future than it is today. So, if you have a client that has a lot of commodity inventory and you can lock it up, you can create some cash flow. Because the other issue that we all have to consider in this transition, you want your clients to get, or borrowers to get, as liquid as possible so they have more cash to deal with the unexpected. So they can't be sitting on their asses now and just dealing with, I got these other plans. You have to be thinking about, I need to get liquid as possible, whether that means moving inventories, getting more quicker payment terms, putting money into the company. They need to get more liquid to deal with the uncertainty that tomorrow brings. So you need to have a war chest for the unexpected. And that's kind of a synopsis. Once again, this is a whole discussion. This is just touching the surface of it. And every situation is difficult, but it does represent an opportunity. And I do think you got to look at the business model, management, and what's the impact of collateral. And keep in mind, a lot of people take comfort. I verify the receivable. You can verify the receivable today, but trust me, if Walmart's not getting their goods on time and has empty shelves, someone's paying for that lost gross margin. So I think that's important to keep in mind, that everything has to be confirmed. You're going to keep top of your suppliers, and reconfirmation and understanding of payment trends are important. And the other side of, one more last thing, going back to the gross margin in different products, the risk is much greater if you have concentrations of customers and product. If you only have two products and are being sold to two customers, that's not a good scenario. Unless you've got something that's very unique and high demand, that's going to be a difficult situation to manage through. So with that, I'm sure Tony and Alan have some, and Bryan has some questions.
Yep. All right. I think I saw Tony's hand up first, so we'll start with him.
Okay. Well, a lot there to unpack. The first thing I was going to mention is that I think there's been a lot of talk about reshoring. My personal view is that for highly labor-intensive products, we're not going to be competitive, and we are still going to be in a global trade environment. I strongly believe that. So unless robots are going to take over, which hopefully won't happen anytime soon, I think we are in a situation where cross-border trade will continue. It will change. We will talk about different sourcing and all this tariff engineering. And the other point I was going to make, the tariff issue today is just one passing phase. We've had supply chain disruptions of all flavors, logistics, wars, pandemics. It's going to carry on. So this tariff situation is just one thing. Hopefully it will end really fast, but it will end. The
That's why it's
cross-border
important to have flexible and dynamic management teams, because you're right, Tony. Things will constantly be changing. This is a kind of a confluence of a number of events coming at one time that people have to deal with. But I'm a big believer, if you lend money to someone that's a talented management team, you have a better option of getting your loan paid back. And I do think nearshoring is not going to happen overnight. I think it will happen. I think you're going to see more robotics coming into play down the road. It doesn't happen overnight. And to your point, Tony, and kind of an underlying issue, who's going to finance all this? Because you do need to build factories if you want to build stuff in the United States, and you do need to spend money on robot technology. So this is another topic of discussion, is that the government has to figure out, just like the Chinese subsidize factories, robotics, that maybe the SBA has to have some type of program that incentivizes people to make investments that make that possible. But I do think you're going to see, and it's not going to be tomorrow, Tony, because I don't think a robot can make a pair of 501 jeans, but maybe down the road they'll figure that out.
Yeah. The other point I was going to make is, I think the risk here doesn't lie only in your customer, canceling a purchase order or playing around with chargebacks, etc. Nor does it only lie with your supplier, but it lies with your supplier's supplier and their supplier.
Right.
So I think what we're going to have to contend with is deep tier due diligence in supply chains, to the extent that global trade isn't going to go away. And I think one of the real benefits to help in that area is the whole digitization process. And I've been harping on this for years, hasn't quite happened yet, but I'm a firm believer that with digitization of invoices and purchase orders and more transparency between the silos of customs and logistics and overseas, inventory, Internet of Things, the more available forms of digital information, the better risk management there will be, and the greater the flow of financing will result.
Right. And there's nothing better than boots on the ground, because technology is wonderful. And going back to management, the companies that strive and actually can pick up market shares as the weaker companies fall down are the guys that are well managed. And you will typically find they have boots on the ground where they're making goods offshore. They'll actually go into factory and say, why aren't my goods on the floor being made right now? They need to be on a boat in 2 weeks. What's going on with the supplier? Let me go see where this is being made. Those are the guys. Yes, technology is going to be a big benefit. It's another check. Nothing better than having boots on the ground. That goes back to having a management team that's experienced. And unfortunately, the trend I've seen, I know you guys can comment, that a lot of importers today are not of the ilk that were there 10 years ago. They don't have the experience. They don't have the contacts that the importers had years ago. Certainly not in my days at Bankers Trust and Bank of New York, when there were really seasoned guys that would spend probably a third of their time in China or some other parts of the world.
Okay, Alan, I think you may have been next. Did you have something to add?
Yeah, actually, I had a few things on what Bob just said in particular. First is the gross margin. That for factoring was never as important as it is now. We were always collateral based. And as long as the receivables were good receivables, verifiable with a good, strong, creditworthy customer, we didn't care as much about the gross margins. We're now asking that up front. What are their margins? Because, as you said, time is now the enemy. If the order gets delayed, postponed, or if because of logistics it takes longer to get there, and the costs are going up dramatically for our client, then his margins are eroded. And many times you have a problem and potentially the end customer doesn't even want the product for several months. And you have a problem now as a factor. So that became important. The second one quickly was on what you mentioned about factories, robotics, et cetera, here in the US in order to bring back more industry. It's also the infrastructure. We were not prepared and are not prepared to ramp up the way we would like to, no matter what the current administration says, without having the infrastructure to handle that properly. And the third one, Bob, I agree with you 100% about boots on the ground and a touch and feel. Because if you're not getting that in person, whether it's in China or with the manufacturer or your client here in the US, you're right, the old-fashioned touch and feel, greeting, boots on the ground is very important, more now than ever. And I think it's going to continue that way.
And that goes back to having good management teams that will actually spend the money, live in China, Vietnam, and understand what's going on.
Agreed.
Bryan?
Yeah, I just want to make sure we don't glaze over what Bob mentioned in terms of supplier diversification and customer diversification, because it's really, really important. And I think it raises its head as we enter into these situations, whether we have trade wars, tariffs, wars, what have you, where it creates supply chain disruption. We come back to the simple thought that if we would have had diversification in our supply chain, if we would have had diversification with our customers, and depending on the type of product that we sell, because if you think about it, again, going back to the supply side of things, without diversification, while it's easy to buy one product or two products from one supplier, you know each other, you know what your payment terms are. As soon as a disruption hits, that affects your entire business. And if you start moving to another supplier, now you've got all these added issues with, what are my payment terms? Are they going to be able to execute? What's my quality going to be like? Am I going to be able to get goods on a boat? Is my communication on a daily basis there and in place to be able to execute and get goods from point A to point B? And on the other side, diversification on your customers. If orders get canceled, if you've got, a situation where you've got a big order with one customer and they change it or they push it back, can you move that product somewhere else? And if you're dealing with this concentration, it's a very, it's an old adage, but we know it too well, but we lose track of it until we have these disruptions. Maintaining diversification on all aspects of your supply chain are going to be critical and are critical to continued success and execution for our borrowers. And we as lenders, as Bob indicated, need to make sure that it's being addressed and make sure that our clients and our lenders our borrowers have a plan for that diversification. It's really important, not something to ever glaze over.
Couldn't agree with you more. There's one other thing I want to mention. We talked about it, about having flexibility to deal with the uncertainty, right? Someone like Ford Motor Company's got billions of dollars on its balance sheet. They can deal with disruptions, paying more. Smaller companies can, and obviously getting liquid is important, but just as important, if the payables are already past due, you're behind the 8 ball in terms of having flexibility. And I always like to say, if you put a gun to Bob's head and say, what is one covenant you can only have in any deal? That's the accounts payable test. Because if I know if I'm current and the payables are relatively current, you may not be making money, but you're not necessarily bleeding out with losses. But if you get to a point where 50% of your payables are already passed through 50%, over 60 days, you can't really have the wherewithal to maneuver, to try to go to new factories. So if you have a limited amount of time, which we all do, you're going to prioritize where I want to start looking at what companies I need to deal with first. Is going to be the guys with the lower gross margins and lack of liquidity, emphasized by the fact that they're already passed through a trip with their suppliers.
And Megan?
I just want to add to part of, the whole relationship aspect of with your clients and whatnot. I think one thing we strongly encourage clients, especially importers, is to also keep a good relationship with their warehouse and their freight forwarders and constant communication with those logistics parties. because I think that's crucial with these with the tariffs, with the trade wars, with everything going on in terms of supply chain challenges. I think that's a key thing that we encourage importers in particular to do, and anyone that's carrying inventory, just to have a constant communication with those third parties that they work with, and to work with reputable companies as well. And that goes for the lenders too. You know, us keeping in contact with those warehouses and the freight forwarders as well, and monitoring those payables.
All right. Before we dive into that last rapid fire question, is there anything else that anyone wants to bring up before we get into that, or add to anything that someone may have said previously?
The only thing I'd like to add is kind of stress that it does represent an opportunity to offer a supply chain finance program to companies that deserve it, that may be stressed for liquidity on a temporary basis, and to establish a new relationship with the buyer outside the bank line. Obviously, it's going to be unsecured, but factors know how to take unsecured risk. There should also be an opportunity on the export side, since the dollar is getting weaker, and there will be some reciprocal tariffs, but there's an opportunity for clients to export more, which we can obviously help finance as well. So there is some silver linings for the industry in terms of there's an opportunity to make some more money on financing those companies. And also supply chain finance does work domestically as well. And that's it. I think a lot of people overlook that. Yes, it's part of channel finance and dynamic discounting, but it does work as well. So that's something that you can look at in terms of making another market.
All right. The last question, we could do this kind of rapid fire style with each participant, but if you could change one thing in the global supply chain finance ecosystem in the next 12 months, what would it be and why? And we will start with Tony.
Right. Well, as much as I have listened to and to some extent agree with the touchy-feely approach of Bob and Alan to managing cross-border trade, I do think that the supply chain finance ecosystem suffers greatly from fragmentation and lack of harmonization. Buyers, suppliers, lenders, insurers, technology platforms all operate in silos. And this hinders, in my opinion, the transparency, delays transactions, increases the cost of capital, and restricts access to finance. So my big wish is that there should be much more use of digital data across supply chains, much more integration of that data to inform the people who are managing transactions in trade, in logistics, and finance, so that there's interoperability and standardization to unlock greater potential for supply chain finance.
Okay. Alan?
Yeah, although I do always like that hands-on and touchy-feely, I actually agree with Tony. One of the things that I would love to see happen is AI or technology just adding better communication between all those parties involved in the supply chain, because the better communication, whether it is between a factor and getting better information from the account debtors on verification, or just between the purchase order to the purchase order finance company, to the inventory lender, to the warehouse information, to the factor, I think better communication through AI and digital technology would certainly help over the next several years.
Okay. Bryan?
I think for me, the biggest thing is just knowing what the rules of the game are, eliminating a lot of the uncertainty and in the ecosystem under which we play. If we know what those rules are, then the supply chain ecosystem is very, very resilient and can adapt and manage and move on down and do what we need to do to maximize profitability and cash flow, and lenders as well. If we know what the rules are, then we can know what aspects of our borrowers we can focus on and make sure that we know how to structure properly. But that also dovetails into what Tony said. I think the standardization of a digitized supply chain finance system that is kind of the basis or foundation for the ecosystem to operate will take away a lot of that uncertainty to many regards. And also, once the rules of engagement are set, be able to maximize it as well. So I think there's two things for me. Most importantly, just knowing what the rules are and eliminating uncertainty. But I think there's a lot to be said about the standardization and the digitizing of the supply chain ecosystem so that we can all operate profitably and maximize efficiency.
Yeah, well, just at that point, I think the ruler in chief at the moment in the United States is the person who could bring some clarity and stability to this situation, because certainly all this tariff changing rules are totally disruptive.
Yeah, I happen to agree with that. Forgetting your politics or anybody's politics involved, the uncertainty that has been created by the current government is problematic for all of us on so many levels. And you're right, uncertainty is a problem. There will always be uncertainty in all of our industries, but getting a little more clarity going forward would be helpful.
And I'll just say my response, mine kind of goes along with that. I mean, I would just say just a little bit more consistency as someone who's in the weeds of this, as Bryan said earlier, day in and day out, and like it or not, we're in the position we're in. And, if we, it just changes daily, hourly even. And I just think a little bit more consistency would benefit all of us. And, it can even get our borrowers to be able to put together a decent cash, which I think is so important. And as Bob said, it has to be more of a dynamic cash flow. But I think if there was just a little bit more consistency for even a short period of time, I think it would help make all of our lives a little bit easier.
Okay, thanks, Megan. And Bob.
Well, Tony, I do agree, digitizing and having supply chain from the retailer all the way back to the manufacturer or supplier on some other part of the world would be great. But I would still go back to tell you, in conjunction with the boots on the ground, and my eyes don't lie. So you can ask the questions, and I also will tell you that as much as we love AI and computers, they can be jury rigged. So the combination of both goes a long way to have certainty. And this motherhood and apple pie, I would think that this back and forth on tariffs is a really disruption, and it's not doing the economy any favor. I think it would be great if we just had a rule set that said, you can raise tariffs all you want, you can lower them, but give me 9 months notice. So I can at least have the ability to resource where I want to. And I think it's a simple rule set. You can't be like, oh, April 1st, August 1st. You can't react. I think it's a reasonable step, and maybe someone will pass a law. I doubt it, but I would say 9 months is a reasonable amount of time for people to start thinking about how I can resource. There can always be an exception if there's a war or something along those lines. But I think that's one of the key things I would love to have a built-in time frame that you can deal with that. The other thing I would just say in general, and this doesn't really so much relate to supply chain finance, this discussion here, is that there have to be better laws that deal with the ability of the end customer always ending up not paying the full bill or not taking the goods. I mean, this is a real problem across the board. It's a problem in bankruptcy. When a company goes bankrupt, hey, I shipped you $10 million of goods, I'm paying you $1 million. There's got to be some legal standard that protects businesses if you ship and fill the order in good faith, obviously not shipping 90 days late, but if you fill those orders in, you can't be taken to the cleaners, because at the end of the day, we've all been victims of, I'm not taking those goods, and by the way, I'm taking a huge deduction. So I think that has to be something that will give the markets more comfort for lenders to step up. So maybe we should have a conversation with Donald.
All right. That was it. Is there anything else that we definitely have enough for the article, I would say, and hopefully it doesn't sound like
You have
we're trying
enough for a book, come on.
I know, even some separate panels, I was thinking. All
Hey,
right.
guys, everybody, thank you so much for taking the time to do this. I think this will be great, and I really appreciate y'all's help. So thank you.
Thank you.
Thank you,
Welcome.
Brian.
Everybody,
Thanks for
thank you.
coordinating, Brian.
You
All
bet.
right.